morning. I'm not that complicated with the numbers what she threw up. I'm as simple as my head. Uh, First caveat, I'm not here to sell any product. I'm here to tell you what is the real estate opportunity we are seeing today and how we have built our business over a period of time. Every product in the country today offered by financial partners are good. At the end of the day, it boils down to asset allocation. We are trying to position our product as part of the asset allocation. As you see, Indian real estate has moved, currently stands at about $650 million. We expect this number to go to $1 trillion. It is very important to understand that what is triggering real estate growth in this country and how the capital is provided to this country. If you go back to the times of early 2000s, the capital was primarily provided by own money of the developers. Banks used to provide money for land acquisition. There used to be a concept called pre-sales. The developer intends to buy the land, he collects payments from the prospective investors, and private money, which used to come at very high cost. That was replaced in 2005 when banks, 2005, 2003, 2004, when banks started providing money for land acquisition. It is important to note in 2005, Reserve Bank of India stepped in and made a first strong regulation to the banks saying that they cannot fund to the real estate sector for land acquisition. We all know what is the reason behind it. The developers used to buy these lands at cheaper cost, hold it for a longer time, and do not process it. So the banks were stopped in doing it. Then in 2005, when banks stopped, that is the time the government also opened FDI. We saw private equity funds stepping in and providing that capital for land acquisition. Followed by global recession in 2008, where the first round of private equity investors had issues in their investments. 2009 is where ASK stepped in this business for real estate fund management. We started providing the growth capital for land acquisition. Up to 2014, it was completely funneled by the private equity funds. 2015 onwards, the non-banking finance companies stepped in to provide this land acquisition capital for the real estate developers. That is when the trouble started. If you see the cycle, I'll give you a preamble before I go to my other slides. The one knowledge or one learning, what we have understood in last 25 years of our experience in real estate is, whenever there is an abundant supply of capital to the real estate sector, the cycle will be volatile and it will be short term. I will prove it, I will show it by the data as we go forward. The large growth of this industry, as Pallav had pointed out, had come from the AIFs. The category 2 AIFs have contributed significantly, and today they provide about 70% of the total AIF investments. It is one thing what I want to point out to you all is that this segment is completely dominated or largely dominated by banking partners. This is one segment I feel financial advisors like you can play a very vital part and increase the proposition and provide this proposition to your investors. What made the industry more robust or more stable is multiple structural and regulatory changes. The industry, what we are seeing today, is more matured than what it used to be a decade back. I will point out a couple of key events, what has happened in this industry, which has brought high level of financial prudence and corporate governance. The first is the introduction of insolvency law. What is the impact of the insolvency law to this industry? The insolvency law provides the home buyers and the financial creditors to take the developer to insolvency. Once the insolvency is admitted, the developer is not part of the project, is thrown out of the project. So the financial threat to the developer is very high. He loses the project on day one. To give you a numbers, I don't want to bore you with numbers, but these numbers are staggering. 1,482 cases are filed for insolvency and admitted in this country. Out of which 800 odd are ongoing. To resolve this 800 odd cases, the industry needs roughly about $8 to $10 billion to resolve these issues. So insolvency is a first significant change, regulatory change, which has brought financial and corporate prudence to the industry. The second biggest event was introduction of RERA. RERA, though at times are toothless tiger, RERA has brought a very strong financial prudence and corporate prudence in terms of completion of the project, in terms of utilization of the monies to be received from the project as a sales receivables. If you see today RERA, every project must be registered under RERA. While registering under RERA, one has to give an undertaking that land is fully legally compliant. The project is completely compliant to the laws as per approved plans. No deviations in the construction of the project. The timelines of the projects must be mentioned. The receivables from the sales must be deposited in the designated RERA accounts. The monies cannot be withdrawn without the construction progress. If the developer defaults in any of the RERA undertakings, he is prone to civil and criminal action, including RERA authorities taking over the project. So one side you have insolvency law, the second side you have RERA, which has brought significant impact to the industry. And we saw a strong liquidity crisis arising out of ILFS fallout. Every NBFC which were operating at that point of time stopped lending money to real estate sector. People who borrowed money for land acquisition were stuck. The NBFCs either accelerated their payments or stopped providing monies to the projects for further completion of the project. The liquidity crisis also followed by certain key RBI regulations to NBFC, stopping them to fund to the real estate projects before RERA approvals. A similar one which they did in 2005 for banks. RBI also hit the nail in the coffin by stopping the evergreening in the projects. What is evergreen in the projects? Earlier, I don't want to name the fund or the fund house. I'll just take it as X. If X as a real estate fund and the same X as an NBFC, they used to roll the project between themselves for a longer period. That was stopped. What the RBI said is, if the X has an exposure to a developer through their fund house, and the non-banking finance company, the non-banking finance company or the bank must fully provision the loan irrespective of the status of the project or the repayment. This sucked out the entire liquidity in the sector. It brought a significant financial prudence. What this has resulted in is consolidation of the industry. Today, the top 34 developers control about 28% market share. In the global economies, developed economies, these numbers are as high as 70%. For example, in US, top 10 developers control 70% market share. So industry is moving towards consolidation. If you take the listed real estate players, they control about 16%. Say 3 years back, if you had 40-50 developers operating in Bangalore, today you have hardly 10 to 15. So that is why you see the listed real estate players having a drastic improvement in their market shares, resulting in their share price. Realty index is one of the best performing index today. If you see on the demand side, we used to have highest supply in 2017, pre-COVID. That is the time when liquidity crisis had hit the industry. A city like Mumbai had 3 years of inventory. That is number of months it takes to sell the unsold stock. That is what we call as inventory. The inventory overhang was 36 months. Today it is 13. NCR, with a population of over 7 crores, had 4 years stock. Today it has come down to 10. Bangalore from 28 to 8. Pune 29 to 8. Chennai 32 to 11. Hyderabad 16 to 15. We have never invested in Hyderabad for technical reasons, and this is one of the technical reasons. The supply is more than absorption in Hyderabad. What is triggering, and if you see the growth drivers in residential sales, in the last year, the gap has widened to 44 million square foot, which means the demand is not fully addressed. There is a shortfall of 44 million houses. This is only in top 7 cities. The key economy drivers are rising income levels, stable mortgage rates. Even today our mortgage rates are 8.5%. In US the rates are 7.5%. You have end user demand. End user demand was because of the supply gap. We have all-time lowest inventory. The other two mortgage drivers, if you see the mortgages to GDP growth, which is one of the important, I would say, an indicator to check the home ownership vitality, is the mortgages to GDP growth. We are grossly underpenetrated. We are today at about 11%. If you see the other economies, it is well above 30%. So we have a strong headroom in that space. As we move towards $5 trillion economy, these numbers will significantly grow, and there lies the opportunity. If you see the other indicator, the housing affordability, which is an important piece for enabling a home buyer to buy a property, is at all-time low. We are at about 3 times of the salary levels to buy the property, which used to be 6 times of the properties. We are a portfolio company of Blackstone. We manage over 86,000 crores. Some of the key differentiators are the team and sponsors are put in 95 crores in our business. We originate deals on our own. We have saved roughly about 60 crores in this. We have clocked 24 full exits and 13 partial exits, that is 37 exits out of 42 investments. Our full exits are made at 19.68% IRR at 1.9 multiple. We have invested in 50 million square foot. These are some of the numbers which I'll ignore. We are present in 5 key cities. We manage over $1 billion. We have a very robust exit track record. The property fund strategy lies in consolidation. When the consolidation has happened, 2 sets of developers have emerged. The first set of developer is a prudent developer who decided to adopt to the structural and regulatory changes and sought solution capital to complete the existing projects and seek growth capital to acquire new projects. So that is the first set of developer. The second set of developer is the one who said, I cannot adopt to the structural and regulatory changes. I will surrender myself to the stronger players. Our opportunity lies in these 2 cases. We support the persons who want solution capital to protect their brand, to complete the projects, what we typically call as recapitalization of the projects. The second set of opportunity we tap is supporting the stronger developer to acquire the project from a weaker developer. So our opportunity lies on the consolidation which is happening in the industry now. The advantages of investing in these 2 opportunities are that I invest only post approvals. Today, approvals take anywhere between 12 to 24 months timelines. As a fund manager, I remove that drag. Removing that drag helps me to underwrite the projects better. The projects throw up cash flows faster. Hence, I am positioning this product as high yield performing credit. It throws up cash flows from year 1. We invest in top 5 cities, though we claim 6 cities. Hyderabad, we have not invested. We invest in job growth corridors. We don't go to Devanallis. We rely around the job corridors. Our investment is predominantly in the mid-segment housing, 75 lakhs to 1.5 crore property ticket sizes. In all locations, Bombay would be 2.5 crores. We have a strong risk management, what we call as controlled investments. The controlled investments is someone who keeps these controls during equity investments. We have ensured these controls in all our projects from day 1. We have invested over 47 projects. All the 47 projects have these controlled investments. The controlled investments means exclusive charge on the project, exclusive charge on the saleable area, exclusive charge on the receivables. Each investment is made at an SPV level and the shares of the companies are fully pledged to us. Personal guarantee and corporate guarantee. Personal guarantee has no meaning, it's on paper, but insolvency is putting pressure, so we prefer to keep it. The most important thing in our controlled investments is we are the sole signatory in the RERA accounts. So which means without our signature, not a single penny can be moved out of the accounts. The one key differentiator what we have, which none of the fund houses in the country has, is the active asset management. The asset managers operate in every city where I invest. These asset managers are masters in civil, having over decades of experience. All the asset managers have spent over a decade in my firm. Our stability of the senior managers are one of the best. The asset managers focus on three important aspects: time, quality, and cost. To elaborate quickly, the time is, what is the time we have underwritten to complete the project? The quality in terms of the project completion. The cost variances for project completion. These three parameters are tracked on monthly basis and reviewed with the developer. We are not like a bank who lend money as a lender, takes a backseat and be a passive investor. We are active fund manager and active participation in the project development, because we strongly believe that if the project is not completed on time, neither the home buyers nor the financial creditors benefit. So we emphasize on project completion. The project completion provides higher velocity and higher sale price. Quickly talking about our fund, it is our third debt fund strategy. We plan to raise 1500 crores. The fund tenor is 6 plus plus 1, 10% hurdle IRR. We are providing 5% plus 1% as sponsor contribution. To check on the benchmark IRR, in the first fund, there are 38 projects, 38 category 2 funds were raised. They have delivered 11.86% IRR, versus that we are delivering 16.21. Out of 38 category 2 funds, 11 funds are real estate funds. They are providing 9.21% IRR. We are delivered 16.21% IRR. This is my second debt fund. 39 funds are raised. They have delivered 10.99 IRR. I have delivered 15.29% IRR. Out of 38 funds, 6 funds are real estate. The real estate benchmark is 18.94. I am at 15.29. The difference is because my last 500 crores are invested less than 1 quarter. It is treated as on par valuation. As the fund matures to a 1 year cycle, we would be about 19% IRR or 20% IRR in this. With this, I conclude my presentation. Thank you very much.